Hello and welcome. In this on-demand video, OJM Group Partner Carole Foos offers insights on choosing the best tax structure for your medical practice to reduce both individual and corporate taxes. If you have more questions or want to learn how to incorporate tax planning into your financial strategy, click the link below to schedule a complimentary one-on-one consultation with one of our experienced team members.
Hi, my name is Carole Foos. Thank you for joining us today. I want to talk to you today about S corporations and C corporations and how to maximize your practice's tax treatment using an S Corp, a C Corp, or maybe both. So let's talk about choosing your practice's corporate structure. When we're talking about corporate structure, you need to remember you're actually making two separate choices. You need to choose, first of all, the legal structure for your practice, and then second to that, your tax structure. We won't get into depth on this, but for the legal structure, as an example, often the limited liability company can serve as the best structure for asset protection purposes. And you can find some of our other videos that discuss that topic. In most states, this is an option for your medical practice. But if we assume that you're going to have a limited liability company that you utilize as the legal structure, that doesn't really translate into what your tax structure of the practice is. And that's because you have a lot of different options if the practice is an LLC. If your practice has a single owner and you're a single member LLC, then you can choose to be taxed as a disregarded entity, meaning all of the income and expenses would flow through and be reported on Schedule C of your individual tax return. Or you may choose to be taxed as a corporation without any further election. That would mean you're taxed as a C corporation, which we're going to talk about in this video. Or you can make an election after choosing to be taxed as a corporation. When you set up, you can elect to then be taxed as a subchapter S corporation. If you are an LLC that has multiple owners, then you can choose to be taxed as either a C corporation. You can further elect that subchapter S corporation status, or because you have multiple members, you can choose to be taxed as a partnership. So a single member LLC can't be a disregarded entity, and a single member LLC can't be a partnership. A multiple member LLC cannot be a disregarded entity. But you do have those choices. And obviously, if your legal structure is set up as a corporation, then you would either be a C corporation or an S corporation. If it's set up as a partnership, then you will be taxed as a partnership. But with an LLC, you do have those choices. So I want to talk a little bit about the basics of C corporations and S corporations. Incorporating or choosing to be taxed as a corporation, if you are an LLC, first and foremost means you're a C corporation. If your desire is to be taxed as an S corporation, then you need to make an election, which is a simple election utilizing IRS Form 2553. It's a couple of pages. All of the owners must sign that election and validate that that's the choice. Both entities, a C corporation and an S corporation, will have their own separate tax ID numbers. They will both file entity tax returns separate from their owner's tax returns. Now, if your practice is taxed as a C corporation, it's going to pay currently that 21% flat federal tax rate on any corporate taxable income that remains at the end of your tax year. You are able to deduct from your C corporation income reasonable owner compensation that is paid to the owners via W-2 wages. However, any distributions of profits to the owners, so any distributions of that income that's been taxed, which you've already paid that 21% corporate tax on, if you then distribute that excess cash out to the owners, it's going to be taxable to the owners on their personal tax returns, generally as qualified dividend income. Now, for those of you who are practice owners who are in the highest tax bracket, that means you'd pay another 20% tax on that dividend income that you receive from the C corporation. And most likely, in addition to that, a 3.8% net investment income tax. If your entity is taxed as an S corporation, so if you've made that election utilizing Form 2553, you're now taxed as an S corporation, then generally you're not going to pay any tax at the corporate level. You'll still file a corporate tax return, Form 1120S, but that tax return will include Schedule K-1s, allocating out each owner's share of income, and that income from the Schedule K-1 will flow through to mostly your Schedule E, but potentially some other schedules on your individual tax return as well, depending on the types of income. So profits that are passed through to the owners, right? You're not having that 21% corporate tax, but you will be taxed at your individual rates. Again, if you're in that top tax bracket, that means your share of the profits from the S corporation will be taxed at your individual tax rate up to 37% currently. Now, keep in mind, you're paying tax on those S corporation net profits, regardless of whether they are actually distributed to you or whether they remain within the entity. You also, if you are an owner of an S corporation and you provide services to the S corporation, so your medical practice is an S corporation, you are a physician who performs services for that corporation, you also need to pay yourself reasonable compensation in the form of W-2 wages. But keep in mind, there's no potential for double taxation in an S corporation. All that income is going to flow through to your individual tax return. You'll either be paying tax on your W-2 wages or on your profit distributions or on the combination of the two, depending on how you receive your income. When we talk about C corporations, a lot of physician clients that we see, particularly those who maybe bought into a practice that was already existing, many of those practices are taxed as C corporations. And some clients starting new practices are also choosing to be taxed as C corporations. So let's talk about some of the thought processes behind that and why maybe you would want to be taxed as a C corporation. First off, we talked on previously about that double taxation, right? Corporate income is taxed at 21%. Any dividends paid out to you are then further taxed as qualified dividend income on your personal tax return. That can be avoided often by reducing the corporate taxable income to zero or close to zero. And that's generally done by paying the owners bonuses at year end in the form of additional W-2 wages. Again, that compensation needs to be reasonable, but as long as it's deemed reasonable for the services performed, you can bonus out income and eliminate that corporate taxable income. So no 21% tax, you'd only pay tax on the W-2 income. Now keep in mind, that's not taxed at qualified dividends rates. You're going to be taxed on that at your ordinary income tax rates. Again, if you're in the highest tax bracket, those last dollars of wages would be taxed to you at 37% as we stand today. For a C corporation, there are no limits on the deduction of fringe benefits paid to the shareholders. By that, I mean health insurance, group term life insurance up to $50,000, or long-term care insurance. If your practice is taxed as an S corporation, then Any shareholders who own more than 2% cannot deduct their health insurance on the corporate tax return. Now, you can generally take a self-employed health insurance deduction on your personal tax return for that health insurance. So for the most part, you're not losing anything on that. But for some of you who have an employed spouse who could cover you on their plan, you might not be able to deduct that self-employed health insurance. I mentioned group term life. As a C corporation shareholder, that's deductible, not for a greater than 2% shareholder of an S corporation. And in addition, C corporations can deduct long-term care insurance premiums for employees as a fringe benefit without regard to any age-based limitations. If you are the owner of an S corporation, those same long-term care premiums would be limited due to age-based limitations. So depending on how old you are, would depend on the amount that you can deduct for long-term care insurance premiums. Now, if you need to keep money in the corporation and you're taxed as a C corporation, you're just going to pay that 21% tax. So if you're planning to keep the money in the entity, maybe better to be a C corporation and pay 21% tax versus paying that 37% individual income tax rate. A C corporation does get the full Section 179 expense deduction as a corporation. If you're the shareholder of an S corporation, you can take your allocable share of Section 179 expense deductions, which is essentially depreciating assets in the year of being placed in service. But if you're an investor in several pass-through entities, all of those entities combine to give you as an individual one Section 179 expense deduction. As a C corporation, if you own rental property, you can use any rental losses to offset practice income. With an S corporation, that rental income or loss is going to come on a separate line of your Schedule K-1, and potentially those rental losses will be limited under the passive activity rules. One thing you do want to consider when determining your corporate structure is thinking about exit planning and future liquidation. So if you're going to sell the practice, and if that sale would happen to be an asset sale, that could be more costly from a tax standpoint versus a sale of S corporation. The reason for that is, as a C corporation, if you have an asset sale, you're going to pay tax on the appreciation of those assets at the corporate level first. And then again, you've got that liquidating distribution, which the owners will also be responsible for tax on. So a potential double tax on the sale of the business as well. For some of you, you might be able to use the best of both worlds. Have a C corporation and an S corporation. If you think about it, many of you have multiple divisions of your practice. If you're an orthopedic practice, you might have ancillary services like PT that can be taxed in a different way from the main practice. If you're a physician practice that has a retail side, whether that's ophthalmology or dermatology, many of you might have some retail sales, which again can be taxed in a different way than what the main practice entity is taxed. So understanding the tax benefits and the tax limitations of different corporate structures will allow you to determine if you want to have separate entities taxed in different ways. Keep in mind also that having separate entities often is helpful from an asset protection standpoint. So some things that you want to think about when you're deciding on the right corporate structure or whether you should consider some change in your corporate structure. First off, think about the impact of the fringe benefits, the expected number of owners. S corporations do have a limited number of owners. Compensation and distributions. Depending on how your compensation structure works, distributions to owners of S corporations must be made pro rata based on their ownership percentages. So keep in mind those profit distributions that we talked about have to be pro rata. Think about your exit strategies and different taxes on liquidation or sale. And then again, consider using both if the practice has ancillary services, retail, or wants a separate entity for management and billing. I hope this has been helpful. Just a little brief introduction of corporate structure and the differences currently between S Corporation and C Corporation tax. Thanks for joining us today.
OJM is a multidisciplinary wealth management firm. We specialize in working with doctors, and our team has helped physicians reduce taxes, protect assets, and achieve their financial goals. Don't forget, OJM Group also offers viewers a complimentary consultation where we can answer your questions to see if our firm might be a good fit for your situation. Simply click the button below to schedule your free consultation. And if you haven't already,